John, there's no doubt the world's had its share of natural disasters recently. How have the international and local markets reacted, and what's your outlook for investors on the current market?
Yes, Danielle, it's been quite interesting following on from last year's string of bad news culminating in the floods in Queensland and Victoria. And since then, of course, we've had natural disasters in New Zealand and Japan, conflict in Libya, and financial issues coming out of Portugal. And the market certainly did respond for a very short period of time. But since then, they've rallied quite strongly. And in fact, if we look at the Dow Jones index in the US, it fell to 11,600 points in mid-March, but has now come back to a high of 12,400 points. That's just 11.4% below its all-time high prior to the GFC. Here in Australia, our market fell to 4,600 points in March, has bounced back now to push through the 5,000 point barrier, but we're still 25.5% under our high prior to the GFC. So that says to us that the Australian market represents good value, and it's quite extraordinary when you think about how strong the Australian economy has been throughout the GFC. Our mineral boom, all-time low unemployment, it just really doesn't quite correlate. But there are a number of issues, and I think one of them is that there's still a hangover of a lack of confidence. People got hurt quite badly with the market downturn, and they're still looking for a lead from the market. On the other hand, the market's looking for a lead from investors. So it's a bit of a catch-22, but we think it's probably starting to improve in terms of confidence, and we'll see a fairly short-term recovery. The other issue is the strength of the Australian dollar, and sitting now at $1.03 US, whereas previously its long-term average was seen to be around about 78 cents. But now the news we're getting is that maybe we've entered into a new paradigm where the US currency isn't as important as it used to be, and it's more where Australia sits in the rest of the growing world, particularly Asia and China. And maybe the Australian dollar is sitting more at its long-term average level now than what was previously seen as being as its average value. So this has an impact on international investment in Australia. If an international investor considers that they can invest $1 here and maybe there's a risk of downside, then they're going to be hesitant. So that's also something that's impacting activity. But with all of that, we're very confident about the future of the Australian market.
I know Hewison Private Wealth doesn't advocate timing the market. Where do you see the biggest opportunities for investors at the moment? Where can they get the most value?
Well, we certainly advocate long-term investment as essential to a successful strategy. But that doesn't mean set and forget, and it doesn't mean ignoring short-term fluctuations in markets. And generally speaking, the rebalance process deals with that sort of thing. As investments outperform, they're rebalanced back to the original asset allocation, and that sort of takes care of that sort of thing. But right at the moment, there are a lot of things happening in the market that people need to be wary about and looking to make changes in their portfolios. There are various sectors that are moving in different tempos. We need to look to rebalance, take some profits, look for opportunity. And it's interesting that there's also been some changes in dynamics in the fixed interest area, where we've seen the introduction, for example, of covered bonds, which have recently been approved by the RBA to allow banks to raise up to 8% of their capital through covered bonds. This is really a new product and will probably have an impact on the hybrid sector. So that's interesting and something that people need to be wary about. And then the commercial property sector appears to us to have very good opportunity, having been in the doldrums for the last couple of years.
It's an interesting time for the financial advice industry at the moment, with the government working hard to regulate it and the future of financial advice legislation making headlines. Can you explain what this all means for investors? How is the legislation going to impact the service that Australians can expect from advisors in the future?
Well, we think it's a good thing, and certainly there are some benefits for the Australian investor. These changes come from two major inquiries, the Ripoll review and the Cooper review of superannuation. And they've come up with a raft of recommendations, but the major ones being, firstly, the ban of commissions. And as far as we're concerned, it's way over time. And it's obviously a good thing for clients to be able to disassociate what is advice and what is product-based reward for the advisor. It's a very, very important distinction. The next is the introduction of fiduciary duty. Fiduciary duty means that you put the client's interests before your own. Now, as far as we're concerned, we've always had a fiduciary duty for clients. I mean, that's our business. We're in the business of giving advice. We're in the business of long-term care and management of our clients' affairs. No product conflict at all. We think this is important. We think it's going to be difficult for a lot of people, a lot of companies in the industry who have both advice businesses and product manufacturing businesses, because where do you draw that line of conflict of interest? And in fact, how do you comply with the legislation requiring a fiduciary duty? But we think this is a great development for the investing public. And finally, because the banning of commissions is not retrospective, the recommendation is that there be an opt-in requirement so that advisors who have clients who are paying them an annual commission on product that have been provided over many, many years will now need to go back to the client on an annual basis and have them opt in to the continuation of those payments. This is a massive problem for a lot of advisory firms, because over decades they would have lost contact with a lot of those clients. So now to go and have them opt in to continue to pay their ongoing commissions is going to be a problem. So it's a big issue for the industry at the moment.
And what effect will that have on the way things run at Hewison?
Really has no impact on us whatsoever. We're an advice-based business. We're a fee-based business. The clients employ us to do the work for them, and if we don't perform, they can sack us and go somewhere else. So we don't accept commissions of any description. We have no training commission arrangements, and we've always considered that we have a fiduciary obligation. So this makes it'll be business as usual for us. It won't make any change. The opt-in requirement may require us to have the clients just renew their service contracts with us on an annual basis. It's a bit of a bother, but really it's of no consequence to us whatsoever.
Thank you, John.
Thanks, Danielle.
Hewison Private Wealth will be holding an Investor Insights evening on the 1st of June in Melbourne, themed Shares versus Property. The event is free to attend, and clients are invited to bring along friends and family. For more information or to register, please visit www.hewison.com.au/news.